Hey, good morning, everybody. Hope your Saturday's off to a good start. Your weekend's off to a good start. Appreciate you taking some time out of your schedule to sit in on another thrilling coffee with Kirk. Today, I'm just going to hit a few things. One, kind of lay out again the sort of deflation versus inflation debate that I've had here for the past month or so. The second thing we're going to look at is some of the actual trades I'm going to be making early next week. And then finish up with just a couple off topics, some questions that I had gotten from clients and an observation that I've got on kind of the craziness coming back in the market a little bit as far as, speculation. So let's jump right into our slides like we usually do. So this week we had the CPI number come out, and it was pretty good relative to what we were expecting. So basically CPI showed that inflation was easing a little bit from the recent trend that we saw going up. But, we're still at 3.4% of inflation. And the thing you have to remember about this is it's a compounding effect in inflation. That's the problem. So even when we had the 8 and 9% inflation in 2022, it's not like 3.4% means we're pulling back here. We're still growing on top of the big inflation that we had. So it's still a big concern, and the Federal Reserve has always said that their goal is to have a 2% inflation rate or below. And that's, the biggest mandate that the Fed has is stable prices. That's, at least according to their founding, that's one of the things that they were going to provide the U.S. economy. And this is sort of just a quick chart of the month-over-month change. So you can kind of see from October of 23 on, we started to see a tick up back in inflation. So this month was a little bit of a drop from where it was. So that's good. But, we'll have to look and see what the trends are going to be and see what happens. But we've talked about this as far as you can make a really good case that we're going to see either slowing inflation or even outright deflation. And I'll go through some of these slides that we've talked about in the past. But to kind of break down, I was reading one analysis and it was pretty good. It said that, of course, this was the first downside surprise since 2023 for inflation. It came in at 0.313 for the month, where they're expected 0.4. And this analysis this guy put out there was like, look, it's the biggest things that have impacted inflation recently are motor vehicle insurance, healthcare has gone up quite a bit, and then of course one of the biggest things is shelter. So most of the increases are those three things, and you'd like to think that at least on the motor vehicle side we've kind of gotten the bump, and hopefully it'll hold where it's at. Healthcare, you're never completely sure what could happen on that one. If another pandemic or something, that could have a negative impact on prices, but I think you could say if we've had a big jump, maybe things will kind of stick where they're at. And then for shelter, things are so expensive if you're renting or buying that, hopefully there's not a whole lot of upside left in that component because, people are struggling. So this is just kind of another chart that gets into the different components. So this is all kind of ex shelter. So we're not looking at home prices here or rentals. So the core services have gone up quite a bit. And that's where you're going to find that, auto insurance, medical expenses, those are going to fall into that. And this guy again was kind of saying, look, the actual core commodities, the goods that you're buying in the store are actually coming down. It certainly isn't the way with, groceries and some of the absolutely needed items, but he was talking more like durable goods, things along those lines. Bigger purchases. So, and that's true. So, maybe we are getting this thing under control, or maybe it is leading to a deflation, kind of a recession. I've talked about really having a good, strong case for that. And the 10-year Treasury has kind of shown that. If you look, if you go to the far right of this chart, you see, basically the past 2 months, as the inflation trend was heading up, so did the bond yields. Remember, when you're an investor in bonds, one of the things you want to make sure is you're getting an earnings rate above the rate of inflation, plus a little bit extra. So you can see we had a move upside to the point where I think the Treasury just broke 4.7% at one point. But then it's pulled back drastically here the past couple of weeks, and now it's at 4.4, 4.43, I think it is. So definitely. So now the bond market said, well, maybe inflation isn't a big problem here, but we'll have to wait and see. Now the other thing too, again, saying that we could have deflation / recession, you'd expect the bond market to act this way as well. And this is a chart that I'd shown before, kind of saying that, inflation should be heading south. If you look at what the market expects for a 10-year break-even inflation rate in the red, and then you look at non-manufacturing prices and they're dropping, typically a pretty strong correlation between these two. So one of two things would happen in this case. We have a pretty big divergence right now. So you either expect the 10-year break-even inflation rate to come down, meaning inflation would come down, or we're going to see non-manufacturing prices come up, one of the two, or a little bit of both. So something to just continue to watch as things progress through the year. And of course, I've talked about the inverted yield curve as an excellent recession indicator. I showed this chart a couple weeks ago. This is just showing you how many days that we had an inversion between the 10-year Treasury and the 3-month Treasury. So we're over 500 days right now, and there's only been 2 instances where, I guess 3 instances where we've had at least that long in the past. And unfortunately, the longer the inversion, when or if we have the recession, it's typically a little more brutal. So you can see the long ones, 07, 08. Then we had, the 70s, 74 was a really bad year. And then, of course, this thing goes all the way back to 1929, where we had a 700-day inversion before things actually hit the fan. But either way, you could say this is something to say that we're not going to have massive amounts of inflation. Could be deflation. And then you look at just kind of what's happening with money supply and bank lending. So this is a chart of what we call M1, which is actual physical cash and checking. And really, past couple of years, it's been shrinking. So there's less money in the economy from there. And even if you look at M2, which is not only just physical cash and checking, but then you throw in money market funds, certificate of deposits. It's M2's supposedly all the cash out there. You can see it's pulling back as well. And then bank lending, as I mentioned just a second ago, bank lending is coming down. So we're starting to see, banks tighten up a little bit. And if banks aren't putting as much capital to work in the markets, in the economy, that tends to lead to lower inflation or even deflation in many cases. So you can kind of see what all the credit for commercial banks has been doing. Really, for the past 2 years, we've started to see total bank lending dropping, and that doesn't surprise me, because this chart kind of shows you are banks tightening their standards for lending money out, or are they getting looser with their standards? And basically, starting in 2023, they've been tightening. So again, you could make a strong case that, hey, we do see moderating inflation, which is really good for us as consumers, and could have an impact on the way you invest, obviously. It would be, if we are seeing deflation, stocks are going to like that. If inflation is moderating, stocks would like that. A lot of risk assets would like that, and so should bonds. So that's kind of a good optimal situation. And of course, we talk about the Fed's fund rate. With the Fed's fund rate still being up past 5%, that's going to be something that should slow down inflation. Money is kind of restrictive, and when it's restrictive, you're going to get less inflation. And looking at things, we had a really bad retail sales figure that came out about I think Tuesday. So that wasn't good. So we're starting to see retail consumers slowing down. So again, as far as inflation, if you have less demand for goods and services, you're probably going to start to see either supply drops or the price drops. And you can kind of tell the reason that retail sales are starting to slow is the fact that delinquencies on debt is starting to climb pretty precipitously. And this is, so delinquencies, and I meant to put the chart in there, but I think I misfiled it or something. I was going to show you, I've been talking about credit card delinquencies going up quite a bit. And then also auto loans are seeing the same thing. Now, these might be the same folks. Like if you can't make your credit card payment, you're probably not making your auto payment. But we're back up over 4% on both of those, which is pretty high. Home loans are starting to creep back up. They're not anywhere near like where it should make us worry, but they're climbing. That's the thing. So, it's the trend. Now, the only debt that isn't seeing more delinquencies is student loans, and that's mostly because the government has halted, repayment of that. So nobody's really paying that back yet. So this is just kind of showing you that not only are delinquencies starting to rise, but a lot of debt has already been charged off by the bank. So the charge off just means the bank says, we're not going to get our money here. Let's basically write this off completely. So the actual delinquency numbers are probably really worse than what they're publishing, because so many banks are just charging these things off pretty quickly, much faster pace than delinquencies. So again, it's not like it was back in 2008. We're not at that level. You can see that big spike to the left. That's the 2008, 2009 crisis. So you could still say, look, we're pretty low as far as the longer term trend dating back to 2008. We're kind of still at a healthy range, but it's the trend that you have to watch, and the trend's definitely heading up at a fast month-over-month pace. Now, so that's the case for sort of a lowering of inflation. You could say disinflation or even deflation. Now, as we talked about a month ago, the actual prices on the ground, the markets are trading as if there's inflation coming. Okay, so a lot of the different commodities are spiking up, and that kind of makes you think that, all right, well, maybe we saw some moderation of prices, but now we're starting to see down the tunnel that things are getting worse. And one of the biggest ones is copper. Copper is just such an enormous industrial metal. Now, you could look at this and say, this is a good sign, because since it's used in so much of manufacturing, that if you have copper prices going up, that means that we're starting to see more economic activity. And if you look at the manufacturing purchasers manager inputs, PMI from Europe, they've started to kind of turn up. So maybe they're recovering. China came out with numbers yesterday saying industrial production increased 7%. the past month. So maybe China's turning the corner and they need this for manufacturing. That could all be the case, that's what's driving it. In that case, it's probably a good thing overall for the economy. It's, if the economy is really booming, you're going to have inflation just because there's such a higher demand for goods and services and raw commodities, which make up those goods and services. So maybe it's a good thing, but it could also just be the fact that, maybe we're starting to see just some general inflationary trends a little bit. Could be less mining for this stuff. I mean, there's a lot of factors that go into it, but the one thing you can say is the price is clearly on the upswing. And why that should concern you is copper has been a fantastic leading indicator for just inflation overall. So if you look at this chart, you can basically see that the blue line, which is copper prices, and then the orange line, which is the actual inflation rate, it's a pretty good leading indicator for what's typically happens in the inflation field. So as copper starts to go up, you start to see inflation come up. Again, it could be a good thing or a bad thing. If it's the world economies are starting to roll again, okay, that's a good thing, and probably inflation's part of that. But if it's just sort of a higher price in copper, we could just start to see inflation rate perk back up and stay. I wouldn't think it would get back to the 8 or 9% we saw in 2022. That had issues like supply chain dislocations and things along those lines that sort of accelerated it. But even if we keep it, what if it goes from the 3.4 it's at now and just breaks up over 4? And that's, again, compounding cost every year. The other thing to look at is the actual sort of foodstuffs. They're rising pretty fast. And if you look at the actual individual chart for all of these agricultural products, you're going to see things are just moving in the wrong direction for us. So continued pain when you go into the grocery store. I mean, I still can't, my wife does a lot of the shopping for us. And so I'll go and, maybe once every 2 or 3 weeks, I'll do the shopping and I can't tell anymore. It's like, is this a good price or not? Like, should I not buy this? Is this overpriced? Should I go somewhere else? I can't tell anymore because the prices change so much. It's just hard to understand that. I'm going to have to start tracking this stuff or something. It's just crazy. But they're perking up. So the on the ground prices are going up there. And then if you just look at the bigger chart, so this is an ETF that we do hold. I've only got a little bit of it right now, but it's the Aberdeen All Commodity Strategy. This is the 24 most liquid commodities that are out there right now, and you can start to see that definitely an upward trend happening here with commodity prices. And one of the big components of this ETF is natural gas. Natural gas has dropped a ton. So when that has dropped considerably and everything else is still showing upward trend, that doesn't really bode well, because if natural gas starts to go up or return to any kind of normalcy, we're probably going to really see some inflation. But you can also see it with some of the other typical inflation hedges like gold. Gold has just been on a tear, and I honestly kind of continue to see it. I think it might be in one of those trends where it's going to do very well for a while. I mean, obviously some pullbacks, all that good stuff, but kind of a bull market. And the other reason I think gold's probably going to be holding its own here going forward for a while is we got to the point where gold's actually less volatile right now than treasuries. I mean, the treasury markets are extremely volatile. As we looked at that 10-year chart just a little while ago, and we saw it went up to almost just over 4.7%, and then in just a couple of weeks comes back down to 4.4. Now that doesn't sound like a lot, 0.3%. That doesn't seem like a lot, but for a bond, that's especially a government bond that's supposed to be the safest asset class. That's a pretty volatile asset right there. So we're at a point right now where, the downside volatility for gold is more favorable than treasuries. And that's kind of unheard of. And then oil. So oils and natural gas are probably going to be the two big drivers of if this becomes inflationary or if this is deflationary. So you can kind of see the price of oil for this year. I didn't put the dates in there, sorry, but we basically at one point got down to about 67 and change on a barrel of oil, but then we saw kind of a move straight up to the point where we got up past $86 a barrel, but it has pulled back from 86 to 79. So if it stays right around this $80 a barrel or goes down, that's probably good for inflation. But if this thing starts to spike too, and it's tempered here the past couple of weeks, I think because people aren't as worried about the Middle East, what's going on there in Israel. I don't think that there's, at least they don't think that the other Arab countries that actually produce the oil are either going to get involved in this or are going to stop supply a little bit more. But that can all change with, stroke of the pen if these Arab countries start to decide that, Israel's gone too far and they're going to punish the world for what Israel's doing. So this is the key one to watch. And I've shown this before. One of the big reasons that you want to watch oil is really pretty negatively correlated to the stock market. So the blue line is the price of oil. The red line is the S&P 500. And you can see anytime oil has spiked up, the stock market has spiked down. So this is certainly something to watch. So if we do get something where oil starts a move like we've seen in agricultural or industrial metals, that could be alarming for stocks for sure. And it would also probably end up manifesting itself there in bonds too. So we are going to add, I do think that there's probably some legs with oil. We have a couple small positions in oil right now, and I'm going to add a couple more small positions. But the thing when you look at these companies, they're really generating just massive amounts of cash flow. I mean, so even if oil stays where it's at, these should, in theory, be very good investments because they're driving so much cash to their investors. And I'll probably bring Cale Smith back in to talk more about these on a stock by stock basis. He knows it really well. I'm kind of just piggybacking him, but these things are just priced so cheaply relative to the market, and they're just generating, like I said, hordes and hordes of cash. And I was talking to a client yesterday, and we talked about oil, that if they continue to restrict, exploration of oil, how's that going to impact oil companies? I said, well, it's actually going to be, in the short term, good for oil companies because, there's going to be less supply in the market and demand's only going to stay where it's at or go up. In that case, you're going to see the price of oil go up substantially, and these companies are obviously going to profit from it. Longer term, that's bad because they're not doing as much exploration. But shorter term, it's a good thing. So Intero, Diamondback Energy, we've owned that before. Another great company. And then this one is a little bit different. The chart doesn't look real pretty right now, but it focuses on natural gas. So natural gas, like I mentioned, I probably should throw a chart in there for you, but it's dropped a lot. And the big reason was the Biden administration basically stopped exports of natural gas, at least temporarily. So what that had the effect of doing is dropping the price of natural gas. And there's a very large glut of it right now. But as that's getting worked off, we'd expect that natural gas is going to go up. So, and again, I'm going to probably paraphrase Cale Smith on this thing, but he said, look, if oil and gas stay at the price they're at right now, the amount of cash flow that this company is producing, it will produce enough cash in the next 5 years to basically cover the entire market cap of the company. So it's about a $3 billion company. So they're gonna, in the next 5 years, if things just stayed where they're at, not even the price of gas going up, you're gonna generate enough cash, free cash flow, and that's after all expenses, everything like that, that you'll produce enough that would equal the entire market cap. So really cheaply, single digit price to earnings. So it just kind of seems like as we head into the summertime, natural gas is probably going to start to make its way back up in price. Another little position I'm going to add is in utilities. So utilities so far this year are doing really well. Now, some people have argued it's the AI story. They look and hear about how much power is going to be needed to actually use AI, and it is. It's a massive amount of energy that's going to be needed. So they're thinking that the utilities are going to profit from this, and they will ultimately. But this could also be sort of a late cycle move that we're seeing. When you get through a typical bull market, the last sectors to start to move to the upside are going to be utilities and consumer staples. Those are typically the ones that you see last. So maybe the move that we're seeing right now with utilities is kind of saying, look, some of the higher flying sectors like technology, maybe those, are maybe a little bit overextended, and now we're going to see kind of late cycle, usually before a recession. But utilities, if you look at this chart here, this is comparing the S&P 500 in yellow to utilities in blue. So, for most of the year, utilities just really struggled, weren't looking very good relative to the market, but then all of a sudden it's really starting to take off. So is it the AI story? It could be. Is it late cycle investing? It might be that too. Who knows? But the nice thing about the utilities too, if you go into it, I think the XLU, the utilities ETFs, kicking off about 3%. Certainly not as high as a T-bill or anything, Treasury bill, but still 3%, not too bad. So even if it kind of just flattens out for a little bit, you're getting paid. And I've talked about this one. I'm going to kind of finally pull a trigger on it. This is the Cambria shareholder yield. So this is more of a mid-cap stock. So if we are reaccelerating in the economy, so most of the market moves thus far, really dating back to 2023, were in large cap tech stocks, whereas small and mid-cap have not moved nearly as much. And what I like about this holding, I've talked about shareholder yield in the past. So this is looking at companies that are either paying out nice dividends, or they're paying down debt on their balance sheet, or they're buying back shares. Those three ways increase the shareholder yield. So these are companies that are really generating good cash flow, and they're helping their investors by doing dividends, debt pay down, or share buybacks. And of course, I put the interview out there with Kevin Carter a little while ago, who started the ETF about sort of the internet and e-commerce in India. And this ETF is trying to find the up-and-coming mobile companies, the up-and-coming online retailers, everything that we saw here, the Amazons of the world, all of those kind of companies. He's trying to find those for India as they start to emerge and become more of a developed market. And there's still so much potential there. They're actually the largest and fastest growing country. And they're kind of skipping the path that we went down, where as Americans, we had shopping malls and things like that, retail. They're going straight to the internet e-commerce, world. So trying to find the Amazons, the Ubers, all that good stuff. They're going straight to that part. And that's what this ETF focuses on. And India's economy is clearly in a strong growth period right now. So those are some of the little moves, little tweaks we're making. Not huge, but adding into those. But also got a question from a client. A lot of people just wonder. We talked about not just us, but as a society, government debt. It's been talked about really. I remember it back when Reagan was president. And he was really increasing it quite rapidly. And people were like, oh, it's even in the 80s, like this is going to blow up in our faces, and you always wonder when it's going to happen. And I use that quote in The Last Coffee with Kirk from Hemingway, from The Sun Also Rises, where they're talking about going bankrupt, and then like, how did it happen? It's like slowly, then suddenly. And that typically is what happens with, debt issues for governments. They can go on a lot longer than you think they can, but then all of a sudden they just can't go on anymore. And that's personal bankruptcies, everything like it happens that way. So I had mentioned in a previous presentation this book called This Time is Different. It's written by Carmen Reinhart and Ken Rogoff, two professors, two PhDs. And, they literally went back 800 years and looked at every country that ended up having a crisis in their currency because of debt. And what they found out that there was two factors in every situation that showed up. When these two things hit, it was basically lights out for the country. So the first one was having a debt to GDP of over 90%. So once the government debt relative to GDP was over 90%, that's the first thing that was there in every time a crisis occurred over those 800 years. Now, we said goodbye to 90% debt to GDP a long time ago. So, we're now at over 120%. I think we're at 123 right now. So we clearly meet this standard. And it doesn't mean that that's instantly going to be lights out by any stretch. This thing could go on for a long time. And then I saw this chart recently from the Peter Peterson Foundation, and they kind of look at a lot of different economic issues, and they kind of come from sort of a libertarian standpoint. So that's trying to figure out exactly some fiscal prudence. That's what they advocate for at the government level, and this is taking the Congressional Budget Office's projections and showing like when do we kind of get to that. So they're saying in 2054, based on the CBO projections, that's when we'd hit 34% of federal revenues being spent on interest on the debt alone. So the figure that Reinhart and Rogoff came up with was 40%. So once you get over 90% debt to GDP, and once the amount of government revenues that are being spent on interest exceeds 40%, those are the kind of lights out. So, if you look at this, you could say, well, we still have some runway. We still have the potential to turn this thing around. The only thing that scares me about this is the Congressional Budget Office. If you look at this chart, I mean, it's just up every single year, but it's very linear. The CBO, when they did their projection, did not put in any more recessions, which would precipitate more government stimulus. So this is saying we won't have any recession for the next 30 years. Excuse me. Also, it has interest rates coming down. I believe the CBO was using 3%. So that would be bringing it down about 2% from where they're at now. So if that doesn't happen or doesn't fully happen, these numbers are going to be off as well. So the issue just starts to become, at what point do we hit that? And it doesn't mean the moment you hit 40%, that's lights out either. Japan has been in both of those categories for some time now. and they haven't collapsed or anything like that. But we talked about this in a previous presentation that they're starting to see it now. They're actually starting to see their currency struggle and their bond market. The bonds want interest to go up. So the Bank of Japan is in a precarious position of having to protect the bond market or the currency market. They really can't do both. And they've been trying since 1990 to get inflation, and they have been unsuccessful up until recently. And now it looks like they might get it in droves. So they could be at that point where the bug hits the windshield, but we'll only see as time progresses. The other thing I just wanted to talk about, it just seems like, again, we're back to that 2020 market when it didn't make a whole heck of a lot of sense. People had the stimulus and they were doing crazy things. The crypto was going nuts and they were buying those. Really any crypto that came out was going crazy, even if it didn't really have a purpose. And there was a lot of hyping going on. And of course we had situation where some stocks that are really defunct and going under, like GameStop, AMC theaters, they were just going crazy. Well, so on Reddit and on Twitter, there's this person called Roaring Kitty. So basically, this was one of the hypesters, back when the craziness was going on. And that Roaring Kitty posted just this photo. This is all it posted. That's it. Nothing else. Put that out there, and then the price of GameStop just started going crazy. GameStop is basically, it's heading fast to insolvency. But as soon as they put this thing out, look at how it jumped. It almost doubled the first day, and then it doubled the next day. Now it's already lost 50% of it. So it's right just back to, you're not investing at this point. You're not looking at any kind of fundamentals. You're not looking at cash flows or profits or anything along those lines. It's just pure speculation, and that never, ever, ever ends well. And it can be further seen, the use of leveraged ETFs. So these are ETFs that might be moved at twice the pace of the stock market, or some of them are 3 times the pace. So extremely volatile ETFs, extremely volatile investments. But you can kind of see we're sort of back to where that crazy phase was. People are just jumping into those things. And again, it just doesn't make sense. It usually kind of denotes sort of the end of the line for folks on that. So we'll see. Nobody knows, but the more when you just sit and you watch this stuff, you're like, this isn't going to end well. It's like watching a little kid that's get a hold of like matches or a lighter or something. You just know something bad's about to happen. Okay, so again, always got the disclaimers. It's not financial advice. It's just general information. If you're not a client, please do your own research, all that good stuff. Okay, so turn those off. I'll try to see, are there any questions? No misplaced the decimal points. Yeah. But it's a month over month thing. That's I think you're talking about the inflation rate, the 0.313. So, but if you do that every single month, that starts to really add up. Okay, how can the Fed realistically expect inflation to get to 2% when shelter is such a large share of CPI and core CPI? Owner's equivalent rent is over 30%, and most people have no idea of what their home would rent for. Most overestimate in the inventory of homes for sale so tight. Government efforts to give people money to buy a home will only accelerate home prices. Yes. Well, so again, it's not let's say today prices just flattened out, and they're still very expensive prices. They're still putting people in a bad position. They're struggling financially where rents are today. So it's one of those, if it just flattens, even though it's burdensome, the inflation rate, the increase month over month, year over year goes slows or goes down. If you don't have any increase in those rents, again, even though they're awfully high right now, if they don't increase, then that would be a positive for the inflation rate, believe it or not. And I've talked about this before, but the Fed extends the housing component to several months. So it's not, that data is sort of baked over a 6-month period instead of current prices, whereas most other things are going to be more current prices. And they did that to keep the inflation rate lower than it actually was. But now it's kind of biting them in the tail end because rents have gone up so high that they've gone up so high that now even the fact that we're averaging it over a 6-month period, it's going to keep the inflation rate maybe higher than it would be otherwise. So it's an interesting component to the whole CPI debate. And then, yeah, there's talk, not just government efforts to give people money to buy homes, but Fannie and Freddie are looking to actually start to be able to do home equity lines, so they could go out and buy all these, HELOCs and home equity line of credits and all this good stuff, or issue them. And they think that could put $1 to $2 trillion into the economy. I mean, you want to talk about inflation, if you just start giving people cash that way, and it'd be a horrible decision for most people. You don't want to just sit and pull equity out of your house for useless stuff. That's a problem. Yeah, I agree. Owner's equivalent rent should be eliminated as a component of CPI. It's meaningless. I do agree with that. It's very nebulous, extremely difficult to really be accurate with it. And that opens it up to a lot of manipulation, things like that. But yeah, it's not a real good one. And then all the moves are inflationary for asset classes, and they're monetizing the debt. That's true. So as we progress down the line, Fed's going to have to be in a position, just like the Bank of Japan was, to monetize debt. We're not going to be able to continue to issue the debt that we are at these rates. So the Fed will probably come in and say, we'll buy any government debt at 1%, 2%. Which will just be massively inflationary. So pretty much any class investing asset will, real estate, stocks, they're going to do very well. Commodities, because we're going to just have tons of inflation. But it's one of those balances. If inflation gets too bad, you have an angry populace, angry electorate. That's not good if you look historically either. So it's going to be interesting, to say the least. If we don't get some sort of fiscal prudence going on in the government, it's going to get even worse. I don't want to bum everybody out, but I could show the unfunded Social Security and Medicare benefits that are coming up, as the baby boomers continue to move through into retirement. So that's going to be a little bit scary. And yeah, we'll see. I'm not sure. I've been saying it a long time. I think the next trend here, 10, 15 years, is going to be more of an inflationary investing environment than what we've had in the past. And it's going to be very different for both stocks and bonds. And, periods where the inflation really spikes, stocks are going to take it on the chin. Bonds are probably going to take it on the chin the whole time. But even within that 10 or 15 years of inflationary periods, we'll probably have bouts of deflation. When the inflation gets too high, the economy slows, and then you have deflation, but then the underlying inflation just kind of ramps up again. a lot of it precipitated by government debt. So, okay, I think that's all the questions. Again, thanks for stopping in. I'm actually going traveling to the UK. My oldest daughter graduated college just recently, and I said, well, you can pick the place we go. And she wanted to go to England and Scotland to see that. So that probably means the markets will go haywire for the next few days because I'll sort of be indisposed. But I'll be checking emails. But if you do send an email or something, please realize I'm on a very different time zone, and kind of on a vacation. But I'll definitely try to get back to you. So the nice thing is she's graduated and she has a job. So that's what you want. Hopefully not a boomerang back into the house. So she's got a job just south of Cleveland, and she starts in mid-June. So that's good. Okay, take care, everybody.